Hello there, ladies and gentlemen, and welcome to another one of Livewire's reporting season interviews. I'm joined by Leon DeWet, who's a portfolio manager at Elston Group. Leon, great to have you here with me today and good to catch up.
Thanks, James. Pleasure's mine.
Now, we're going to be doing another one of our two stock specials in just a moment, and we're going to be talking about two really interesting and iconic Australian businesses in Sydney Airport and Transurban. Lots to talk about on each of those companies. But Leon, before we get into the stock specifics, for our viewers that don't know Elston and haven't heard you present before on Livewire, could you tell us a little bit about your philosophy and how you think about putting together portfolios?
Sure, James. Look, Elston really, I guess, is what I would view as a traditional fundamental manager. We really are, I guess, sort of focused more on the long term. Our time frames are generally sort of 3+ years when we're looking at building those portfolios. So we are prepared to look through, I guess, some of the shorter term weaknesses. Sometimes we believe that is actually potentially an opportunity that the market presents for patient investors. So yeah, generally sort of a 3-year plus time horizon, fundamental sort of style agnostic manager, I guess, is how I'd characterize ourselves.
Okay, now we're going to be talking about Sydney Airport and Transurban. As a opening question, do these stocks feature in your portfolios?
So Sydney, yes, that is one that we do own in our portfolio. Transurban, no, we don't currently own Transurban, James.
Okay, that's a good backdrop. Let's get into the results now. We've got to get through both results, so the ball is in your court to keep us moving. So let's just start at the high level. Key lessons from the result from Sydney Airport, and then maybe jump into Transurban.
Yeah, no problem. Okay, so if we look at Sydney Airport, look, I think probably some of the key takeouts for us, they're definitely able to withstand, the cash burn. Management have flagged that sort of 5 to 10 million per month, and we think even if the lockdowns are extended to the end of the year. The other one is also that even if the company doesn't refinance any of its 950 odd million of debt that matures by the end of next year, we think it does have ample liquidity to meet those obligations. I think we're comfortable really in a combination of things. Obviously, strong balance sheet, $500 million of cash, 2.4 billion in undrawn debt. We've clearly seen demand for travel rebound quickly when restrictions are lifted. I think that's important because if we look at sort of the April to June period, pre the lockdowns, this business was cash flow positive. We think they will certainly return there reasonably quickly. And then finally, probably reasonably fortuitously, we got the timing of the 200 odd million payment that Sydney Airport's going to receive related to that Sydney Gateway. So those are probably the key positives. I think the negative takeout is absolutely around air traffic. Basically, it's come to a standstill. That's both domestic and international travel. I think it was only around 3% of pre-COVID levels. And with lockdowns extended, measures seeming to be tightened all the time. But I think, the reality is the recovery that certainly we and probably most analysts that expected had certainly been delayed sort of to the second half, at best. If we look at Transurban, I think staying on the negative theme again, it's really around those traffic numbers. We saw quite clearly the severe impacts on weekly traffic in terms of the data that they provided. So we think, it's unlikely that we'll see any substantial improvement there, probably till, it's a guess, but probably October at the earliest, we'd say. That's going to weigh on earnings, free cash flow, and obviously in turn on dividends. So in essence, again, it's really around recoveries that has been pushed out probably to financial year 23. I think the other thing, probably a takeout for us when we're looking at Transurban, previously we had them citing contractual obligations with respect to that Westgate Tunnel, that they were probably going to have a limited contribution. Certainly, our take on the commentary now is that that pain will probably be shared, and it's potentially quite a big hit. Cost overrun, they've come out and said it's sort of $3.3 billion. So we think that they are are probably on the hook there for a fairly substantial payment. Look, they're incentivized to get this project completed as quickly as possible. If we think about the Westgate Tunnel, they do have sort of tolls there that are escalating at 4.25% until June 29, but those reduced to quarterly CPI thereafter. So, my understanding, there's no extension of that sort of 2029 date, and so I think they want to get that done pretty quickly. I guess the knock-on of that, unfortunately, is you're probably going to have a partial offset in terms of those capital releases that we think are going to happen over the next 4 odd years as they have to sort of fund their contribution there.
And with results, I mean, it can be a terrible result, but if it's not as bad as markets or analysts expected, we can still see a positive for the stock. Just in terms of expectations across both companies, how did those results present compared to what the market was expecting?
Yeah, look, I think the good thing with both of these stocks, we obviously get traffic numbers on both of them on a monthly basis. I think certainly from that perspective, there probably wasn't, sort of a significant surprise. I'd say, Sydney Airport's first half revenue, that was probably a little bit better than consensus and our expectations, frankly. But again, for context, we've got to see that, that was still sort of 57% below pre-COVID levels, 57% below pre-COVID levels. So it's difficult conditions. I think we were probably a little more pessimistic than consensus as regards to the costs. So if we're looking at it sort of at an EBITDA level, I think there was around about a 9% miss there on consensus. And then obviously distributions, look, nobody was surprised there that those remain suspended and likely will for the foreseeable future. On Transurban, our expectations were broadly in line actually with consensus on Transurban. And we were a little bit, sort of too optimistic on the revenue. So that was a sort of a 4 to 5% miss. The good thing, though, is Transurban actually showed exceptionally good cost control. So if we strip out their strategic initiatives and the new assets that they brought online, the underlying costs were actually 10 million lower than last year. So at an EBITDA level, they were brought in line with consensus. Again, distributions pre-announced, and no surprises there. I guess for us, at least, if there was a positive surprise, it was probably around cash flow, free cash flow. Unfortunately, that was because of the capital releases, which they sort of guided to not happening. But I guess that's how I'd summarise those results. Thanks.
And what about the outlook? Obviously, a difficult environment for anyone to give guidance. What's your view on the way forward for these two businesses?
Yeah, look, as I said in the introduction, we are shareholders in Sydney Airport at the moment. So I suppose, unsurprisingly, we're reasonably positive on the outlook. I think, as mentioned, though, experience has shown us that, sort of both here and abroad, travellers do return, reasonably quickly once those restrictions are lifted, and we think that'll certainly happen. If I look at, sort of my colleagues and circle of friends, I think there's definitely a desire to travel. And so when this happens, we do believe that, Sydney Airport, which I think you mentioned being iconic, it is a central hub. It's Australia's busiest airport, pre-COVID. So it's exceptionally well positioned to benefit. I think that said, it is, as you say, very difficult. It's a tough environment. The rules are constantly changing. So I think patience will be required for that full recovery, particularly in international passengers. Vaccinations, I think, especially amongst emerging countries, that's clearly just one wild card. But over the medium term, we're optimistic. And we think certainly the growth in Asian passenger volumes, as that region's middle class expand is a plus. And we know that, international passengers are around 3 times more valuable to the airport than domestic passengers in terms of revenue generated. So, we think there's good operating leverage there over time. Positive on Sydney, as I say. If we look at Transurban, again, I think as regards to the earnings and the dividend outlook over the medium term, we think that those current lockdowns do push the recovery out. But once again, similar to air traffic, it does bounce back. Vehicle traffic bounces back pretty quickly, and we see no reason why that won't be the case. I guess the one positive for Transurban vis-a-vis Sydney is they're only relying clearly on domestic, and so as we have got the vaccinations increasingly rolled out, we really don't see any reason why restrictions should be an issue for Transurban sort of after the first half of next year. So by 23, we think traffic's back up again, above sort of pre-COVID levels. Dividends bound back fairly strongly. We'd say, probably about 60 cents, maybe even a little bit higher, just depending on the kicker that we can get from distributions related to capital releases that are still expected to come over the next couple of years. I think the other thing, though, that I'd also just highlight, which is important for Transurban, is really just around the growth option on the New South Wales government sale of their 49% stake in West Connex. That's obviously an asset Transurban understands very well. They've been operating it since 2018. We do think they will be successful on bidding for at least one of the two tranches. So outlook positive there as well.
One of the big events for Sydney Airport has obviously been the consortium of super funds putting in a bid for that asset. What was your take on the board rejecting that bid? Did you support it? Do you have a view?
Look, we certainly do have a view. We can understand, I guess, why the board is trying to maximize the value for shareholders. And we certainly would agree on some of the reasons that they have mentioned, for that rejection. So, the strategic and irreplaceable nature of the airport, the earnings, the sort of diversity, the land bank and all the development opportunities that exist there. So absolutely, we agree with all of that. We do think, though, that, certainly at the revised offer of $8.45, to us, that's probably a point at which we would think it incentivizes at least management, to be engaging with a consortium. So I think along with, the largest shareholder, we'd certainly be advocating for, for those discussions to be taking place, given the current bid.
All right, a couple of questions just to wrap us up, Leon. For people looking at increasing their infrastructure allocation, why or why shouldn't people be considering Sydney Airport and Transurban?
All right, so probably Sydney first again. Look, I think as we've mentioned already, and in our view, it is probably endorsed by the consortium's bid. For us, there's long-term value in Australia's busiest airport. It's a critical hub, given its global connections. As international travel returns, we believe that will happen. Yes, the timing is uncertain. It may be a few years from now, but absolutely passenger numbers will exceed pre-COVID levels. I guess the risk, though, that I would just highlight is the uncertainty around the outcome of negotiations on those longer-term aeronautical agreements. Those are critical because they set the landing charges with the airlines. And I think despite the diversified revenue base, the reality is that those aeronautical fees in ordinary times are still the single biggest contributor to revenue. And so we do need to have a resolution on that. It's been pushed out again for another year because of COVID disruptions. But that's probably something that we do need to just be mindful of as those negotiations sort of get underway or continue. I should say they are underway. And then on Transurban, for people looking at it, look, I'd say besides the issues discussed already, I think Sydney Airport, not Sydney Airport, Sydney, the city, where it generated about half of its financial year 21 revenue. Now, admittedly, that was because Melbourne was impacted. But the reality is it has stakes in pretty much every toll road in Sydney. So it is exceptionally well positioned to benefit from further expansion, in Australia's most populous city over time, particularly when we think that, Transurban really has very long duration concessions across its portfolio, including Sydney. So these are sort of 30, 40, or even longer sort of year concession. So a long time to run. I think the other consideration, for us from an infrastructure investor's perspective is we do think it provides decent protection against the impacts of inflation and real purchasing power. So if we think the vast majority of their revenue have embedded escalations of CPI or greater, so you got concessions like the M4 or the M8, M5 East, there's others. They've all got escalations of sort of greater of CPI of 4% annually. So within there's a good underpin there in terms of providing real protection of purchasing power.